The latest inflation data brings encouraging news for American households and the broader economy, signaling a potential shift towards greater consumer purchasing power and economic stability.
America's inflation rate just hit a significant milestone, easing to 2.4% annually in January. This marks the slowest increase since May of last year, delivering welcome news for consumers across the nation. The key driver behind this slowdown, a notable drop in used car prices, offering a tangible reprieve for household budgets. This trend could translate to more breathing room in your finances and potentially less pressure on interest rates, making borrowing more affordable for everyone.
This latest report builds on a consistent pattern of moderating price increases. The Consumer Price Index, or CPI, which tracks a broad basket of goods and services, showed a notable deceleration. In December, the annual inflation rate stood at 2.7%, meaning January's 2.4% represents a significant step down. This trajectory is crucial as it indicates a broader cooling in the economy after periods of elevated prices. We can see how this trend has unfolded over recent months, offering a clearer picture of the progress being made.
Delving into the specifics, the easing inflation was predominantly driven by a sharp decline in used car prices. In January alone, the price of used cars fell 1.8% from December. This sector was a major contributor to higher inflation during and after the pandemic due to supply chain issues, but now it's helping reverse the trend. Beyond vehicles, gas prices also saw a significant drop of 3.2% last month, contributing to the overall cooling. Even shelter inflation, a persistent concern, showed signs of moderating, easing to 3% annually from 3.2% in December.
For the broader economy, this easing inflation carries significant weight. Slower price growth often leads to less upward pressure on interest rates. The Federal Reserve has a long-term inflation target of 2%, and this latest data brings the economy closer to that goal, giving the central bank more flexibility. This improvement in inflation metrics could ease the path toward potential interest rate adjustments sooner rather than later, according to some analysts. For businesses and consumers alike, more stable and potentially lower borrowing costs can stimulate investment and make larger purchases more accessible, contributing to overall economic health. It's a key factor in how the Fed will navigate its monetary policy decisions in the coming months.
What are analysts saying about the road ahead? Many financial experts forecast that inflation will continue its decline through the second half of this year, eventually approaching the Federal Reserve's 2% target by the end of 2026. Neil Burrell, Chief Investment Officer at Premier Mitten Investors, stated that the January report is likely to ease the path towards a cut in rates sooner rather than later. However, challenges remain. Some warn that further progress could stall if companies begin to pass on the costs of tariffs more fully to consumers, or if persistent labor shortages push up prices for services. These factors will be critical to monitor as the year progresses.
Looking ahead, the sustained cooldown in inflation offers a more stable financial environment. While the overall cost of living remains elevated compared to 5 years ago, the direction of travel is positive. Policymakers will continue to watch for upcoming economic data, including future CPI reports and employment figures to guide their decisions. The trajectory of used car prices, energy costs, and the stability of supply chains will remain key indicators. For businesses, this environment could foster more predictable operational costs and investment strategies.
This is GeeseFinance.